Okay, GM guys, how are you doing today? Welcome back to this episode or to this series of this video. Okay, so in this video we're talking about three topics, which is psychology, trading psychology, risk management, and then economics. Economics in essence, fundamental analysis. Okay, so that's the three topics I'll be discussing in this video, and I won't promise it won't be so long, but I'll do my best in order to compress it and then make it very much shorter so that it will be very understandable. Alright, so let's get down into it immediately. Okay, so we're talking about psychology now. What is psychology? Now, psychology can be said to be the mental characteristics or an attitude of a person or group. Now, that is psychology in a broader view. Okay, so let's narrow it down now to psychology in trading. What is psychology in trading? So psychology in trading is the importance of awareness, self-awareness, emotional control or regulation, and then risk management, discipline, and resilience in order to make more profits in the market. So in essence, basically what I'm trying to say is trading psychology represents the aspects of an individual's character and behavior that influences their trading actions. There is nothing else to say aside that. Trading psychology are set of actions that represents a person's trading lifestyle. That is just a summary of what the whole thing we're going to be discussing now on psychology is. Okay, so without wasting much of our time, let us discuss what trading psychology is. So, first in trading, a successful trader know this, and the concept is trading is 80% psychology and 20% methodologies which are technical analysis. So basically, if you have a strong psychology and then you have your technical analysis all set up, you're going to be good. But if you have your technicals and your psychology is wobbly, you might have some issues at some point. But up until you fix the psychology through discipline and resilience, then you will get the hang of it immediately. Okay, so money management in trading now. Let's discuss money management then. We'll then get back into psychology. Okay, so money management is composed of two essential elements, which is one, the psychological management, and two, the risk management. The risk management is the next topic. So now this psychological management is one thing. Alright. So we will discuss something that we might not be going into full details because psychology is not really a teachable topic. Okay, it's rather something you go and develop on your own. It's an enhancement plan. Okay, so I'm recommending the book The Disciplined Trader by Mark Douglas. I've actually read this. Now you can also add what's the name of this book again? You can also add this book by Ryan Holiday. Ego is the enemy. It's a stoicism book. It can help manage emotions. Okay, so two basic emotions you see in trading are greed and fear. Some persons tackle FOMO, fear of missing out, still fear. Okay, so that's the two basic emotions most traders experience in the market, and it's been weighing them down for quite a lot of time. So there are basic few things that I look at while taking a trade. Okay, more like just to analyze my psychology before I get down into it. So one thing is I analyze the trend. In order not to mess up my psychology, I analyze the trend so that I will follow the trend because the trend is your friend. You have to follow the trend. You can't go against the trend. Otherwise, you're setting yourself up for a loss. Okay, so you analyze the trend, find out which direction is going, and so and so. Then you check who motivated the trade, check what motivated the setup, the entry. Okay, that's the second thing you will do, and then you can now find a way to enter your trade. If it's a win, you can still go back and review how is it a win, what caused the win. If it's a loss, still review again what caused the loss and how is it a loss. Okay, so that's the basic things I do whenever I decide to set up a trade and take that trade. Alright, so let's get into risk management now. So risk management is just a basic concept of managing your capital. You get that is like taking a capital of 100% and then managing it so that before the capital finishes now, at least you've gotten somewhere or not even finished. Okay, so that's basically what management is. So there is this rule, which is the 1990 rule in trading in risk management. So the rule says 90% of retail traders use 90% of their capital in the first 90 days of trading. Now, why is this so? This rule is actually very common between beginner traders. Very, very, very common between beginner traders. I had the same mindset. I experienced the same rule. Okay. So the reasons are: number one, most retail traders take this business, because I take it as a business. Trading is a skill. So they take it as a get rich quick. Okay. They have this get rich quick mindset. Okay. And that is one thing that crashes somebody's psychology, crashes somebody's whole interest in trading, because they be like in certain months I'll be good, I'll be good, I'll be good. Yes, quite some persons are good in certain months, but it's not the same for everybody. You can practice and practice and practice for it, and you're still not actually getting it. So firstly, remove your mind from it being a get rich quick scheme. Secondly, many traders take trades without using a stop loss. Now, that is one pitfall many people fall into, and I had once experienced this. But then along the line, you find out that not using a stop loss is a very heartbreaking experience. You get, so use a stop loss all the time you want to trade, no matter what entry you're taking. Use a stop loss. Now, the third point is most persons don't have a real strategy. They just get into the market and do this and do this and do this and do this, and they feel like the trade is going to go well, and they enter the trade, and eventually they end up losing their money, losing their capital. Okay, so you have to have a real strategy. Define what your strategy is and also refine it to a pattern that suits you. Okay, trading is more like a personal game, so you have to talk about yourself. Don't follow somebody else's principles. That's basically what you will do in psychology and risk management, depending on how much risk appetite you have. Okay, so another point is getting caught at the wrong side of the market. Now, that's what I've already said before. The trend is your friend. So if you go against the trend now, you're being caught at the wrong side of the market, and eventually you will lose that trade. Okay, so you have to be able to discern very, very well which direction the trade is going, and then follow the trend. All right, so number five reason is a poor risk management. Now, for somebody that has a very poor risk management, it's going to be very, very hard for you to become profitable, because you end up funding and losing, funding and losing, funding and losing, because you cannot effectively manage how much you take, how much you leverage for every position you take. Okay, so you must be able to know what you're doing and not pushing all your capital. Like take a certain percentage of it. Let's say, for example, you fund $100 and you want to take a trade, whichever RR it might be. RR is risk to reward. We'll discuss it later on in the video. Whatever RR it might be, you can take a certain percentage of the $100 and then take your trade. And if it's a loss, you still have some capital to go again. If it's a profit, then you're good to go. You're on floating profits. All right. So there are basic tips that I personally have followed and I'm still following, and it still works and will still work in years to come on risk management. Number one is I develop my discipline for my trading rules. Okay, so I set down rules now that I wouldn't trade at so and so time. I wouldn't re-enter this so and so position when I've taken a loss on it. So those setting rules now are my trading rules, and I must have to develop discipline in order to follow those rules in order to protect my psychology and my capital. Number two is to always use a stop loss. I've emphasized on this stop loss. It's very, 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 very important to use a stop loss. I can't overemphasize on the importance of a stop loss, because let's say there is slippage in the market and you're not using a stop loss. Eventually, you lose the whole account and you might not like the outcome of it. All right, so the next tip is to have a real strategy and a good approach. Now, if you have a real strategy, one that fits you, you defined your edge very, very well, and you get into the market, believe me, it's a good approach because you're going to make a whole lot of money. Okay, so the next one is to follow a risk to reward approach. Okay, so I normally do this now when taking a trade. It's actually in technicals. Now I want to take a trade of 3RR, that is risking one to get three. That's a very good risk to reward approach. Not somebody risking one to get one. It's nothing because you're not making any profits from it. It's just like risking $50 to get $50. There is no profits in it, so it's a bad risk to reward. So the least risk to reward personally I take is 1:3 RR. This is because let's say I take a loss on this trade now, then on the next trade I also take a loss. Then on the third trade now, I might take a win and it's 3 RR. Now compounding it now, I'm still on profits. Okay, from that last trade now, I'm still on profit and I've covered the losses I've taken before. So if you approach the market with a good risk to reward, you're going to make a lot of money. Alright, so the next I'm going to talk about is limits and goals for loss or profit. Okay, so there is a personal way I define this now. Whenever I take any trade and it's in profits, I will still go back and check. It's called self-reflection. Okay, so I go back and check the trade. How is this thing going well? Why is it going well? And then I document in my journal. It's actually very important to have the journal for journaling your trades and the emotions you feel during the trade. It helps to go back to it and then refine yourself from past experiences. So I go to my journal and then I write down, why is this trade going well? What caused the trade to go up, so that when I come back to backtest the pair, or when I come back to do anything again with the pair, I'll go to my journal and then look at the previous actions, look at what it has done before, and then I can know what next to do. Okay, so if it's a loss, I'll do the same thing. I'll write in my journal, why is it a loss? Was there a mistake I made? How did this happen? How did this happen? Did I get caught at the wrong side of the market? Because one thing people don't tell you is even your professional traders take a loss. It's part of the business. Yes, it's part of the business. Losses are bound to happen. But it's the compounding that is the most important thing. At the end, are you profitable? Okay. So I think that'll be the end of our risk management. Let's now get into economics, which is the fundamental analysis. Okay, so without wasting much of our time, it's already 13 minutes. Let's push it further. Alright, so what is fundamentals? Fundamental analysis or fundamentals now are the drivers in the market. It's more like a news, like the create volatility. They don't give direction. Many people are confused that news creates direction in the market. No, they don't actually give direction. Just give volatility to the market. And then depending on the area of value, you find out the direction the trade is going. Alright, so what is this technical analysis? Now, it's the method used in the financial market. It can also be used in crypto because there are news actually used for crypto. You can find it out in CFT.com. That is the site for checking news for crypto. But for Forex is forexfactory.com/news. Okay, that's the site you can check. So fundamental analysis is the method used in the financial market to analyze and evaluate the intrinsic value of a currency pair of a pair. Okay, so these are majorly news that affect the currencies, and there are certain news now that always have this effect on the currency. Such news are economic indicators like the likes of gross domestic product (GDP), inflation rates, employment data. Okay, employment data shows the jobs market health. GDP, gross domestic product, measures the country's economic output. And then the inflation tracks the rise in prices over time. Okay, we can also have interest rates. Interest rates, the CBN, okay, not CBN now because CBN is for Nigeria, Central Bank of Nigeria. But then in most banks now, in most countries now, they have a central bank. So depending on the central bank declarations, okay, it can affect the interest rates and then change the effect of the currency value. You get, so that's basically what it does. Now they have the higher rates that it can actually attract foreign capital, that is investors now to invest in a certain currency and it will go up. So other examples are political stability, just like Trump won the last year's election. Okay, so and after winning, there was this fluctuation they had in the market, the crypto markets, particularly. So these fluctuations now can actually be political stability. That is also is under political stability now. Can also add the social factors. Now the social factors are when a good population of the country contributes to a robust economy. You get it can actually be from works contributed. That is like this menial jobs or from entrepreneurship jobs. You get so it contributes to the stability of the currency. All right. So how do we analyze news? How do we analyze news? Now, as I've already said before, the site is forexfactory.com and it's an app used in news analysis. Okay, so if you see what we're doing now, if you see what on our screen, so there are some folders on this the upper part of the screen now. Okay, so these folders now basically give you the importance of the news. So it's more like the red folder now. It's for a very important news and a high impact news that is expected, and the brown folder is the medium impact news that is expected, and then the yellow folder is the low impact news expected. So this high impact news now has a high risk of changing the volume in the markets, like it can cause volatility way too quickly. Okay, so and that high impact now is the likes of GDP, gross domestic product, inflation rate, and employment data, and so forth and so on. Even FOMC, FOMC is also the NFP, CPIs. Those are high impact news. Then medium impact news can be interest rates, bank interest rates, and higher rates and lower rates that can actually attract investors. Now, the low impact rates can be something like on these social factors now. Those are the low impact news. Then you can find um, non-economic news. These are still informations of the country that might not give any effect on the currency, but at some point, depending on the values of the news, some movements can occur in the market, and that is it. All right, so I want to believe you've gained knowledge from this video, and it's been nice having you watch this video. So there is a link in the bio. It leads to our playlist. Now the playlist contains all the videos that we've created. So hit the link in the bio and go view those videos. Believe me, you will find it very much important. Okay, because I'm telling every single thing that I know and putting out there so you can watch it now and gain the same knowledge that I have. Alright, so this will be the end of this video and I hope to see you next time.